Good afternoon, everyone, and welcome back to PBA at Noon. I'm Paul Benwell, and I'm joined by my colleague, Sophie Caesar. Today, we have with us Trillion Energy, which trades on the CSE under the symbol Tom Charlie Frank. Trillion is a Canadian-based oil and gas producing company with multiple assets through Turkey and Bulgaria. The company is 49% owner of the SASB natural gas field, one of the Black Sea's first and largest scale natural gas development projects. Currently, the company plans are to ramp up production of its Black Sea natural gas field. Here to tell us more is the CEO, Arthur Halloran. Welcome, Art.
Thank you for the introduction. It was great.
And we will take questions in the Q&A and answer them once Arthur is done. So Arthur, feel free to start whenever you wish. Thank you.
Okay, I guess we will start right now. So I'm Art Halloran, the CEO of Trillion Energy. And as mentioned, we're an oil and gas producer in Turkey. The picture here you see on this slide is one of our platforms. We're listed on the Canadian Security Exchange, TCF, and Frankfurt and OTC as TCFF. The next slide, please. And then also the next one. So as mentioned, we're an oil and gas producer in Turkey. We're re-domiciling right now to British Columbia from the USA. And we have our shareholders vote December 17th for that. Our net income for the last 3 months ending this September 3rd was 5.4 million US. End of third quarter, our cash position was about 1.5 million US, and we produced 176 barrels of oil equivalent per day. Our major development that we're going to ramp up is our Black Sea gas asset, which is SASB. We own 49%, and the Turkish Petroleum, the government company, owns the other 51%. And it's a total sunk cost of about $600 million. And that's because of all the facilities and platforms and gathering systems. And to date, there's been about $355 million worth of gas produced from four pools that were discovered and put on in 2007 and 2011. So we really have a good understanding of the reservoir and the production capabilities of these fields. We have a large gas adds. We have 4 discovered unproduced gas pools, and then we have 6 low-risk development gas pools. And in addition to that, we have a lot of exploration. Just recently, the Turkish government had some major discoveries in the Black Sea, north of us about 80 kilometers. And we're in the order of 19, 20 TCF altogether. And this is a game changer for the area, because the conversation before was there was not enough gas to charge large structures. And you'll see, I'll mention it later on in the presentation, why this is important. And this proves that there is. We also have a oil field that is a very profitable, low decline field, and we'll make over $3 million to Trillion Energy for 2021, and we get over $80 a barrel. Next slide, please. So here's the SASB natural gas field in the Black Sea, and you can see in the upper insert there is SASB, and then north of that is the Tuna discovery by the Turkish government. So we have 4 producing platforms that have produced 42 BCF, and we're going to add about another 100 BCF. And this is really important because we actually picked up our 49% of the large gathering system and facilities and so on for about $2.7 million. So that cost is already all sunk. So now we're just utilizing this facility by putting on gas that exists there. We have a third-party engineering report. And the one thing I'll say is that these values are the old pricing forecast, which we had to use December 31st, 2020, which was the lowest price we've ever gotten there. We usually range between $7 to $8 an MCF. And at that time, we were just about 5.5. But now we're getting over $10. And so we have got a new price forecast, and we're getting the reserves and value redone. And we'll get that out in the next week or so. But even with the old low price forecast, you can see that this is very economic project, in that the NPV 10 for us, our percentage before tax for the reserves, and that's proven 100%, is about $57 million, and we'll get a cash flow 1.2 to 1.8 million net after all costs per month. We also have those 6 low risk development locations or prospects, and there again we're about 82 million NPV 10, and so combined it's about 138 140 million US NPV 10 for the discovered pools that are not produced and the development pools. And additional to that, we have a lot of exploration potential on the block. Fiscal terms are very good, 12.5% government royalty, and corporate tax is 25% this year and 23% next year. Next slide, please. This is just a quick illustration. So you see there's 4 offshore platforms, which look exactly the same as that picture you saw in the beginning. Subsea pipeline gathering system to an onshore facility that is rated for 70 million cubic feet per day. Next slide, please. This is just illustrating the price we're getting now for our gas, and part of it's to do with of course, the gas crunch in Europe. But the other issue is that our gas actually is benchmarked to the Brent price, and the price of Brent now forecast is going to give us above $8 MCF gas from now until the near future. But when we had to do our calculation was, of course, in January, and now we're in November, and so we're redoing it. Next slide, please. This is the nitty-gritty of the gas pools. So the red stars are the existing pools that were produced, and so we have experience from birth until death. They're still producing. Those are where the platforms are sitting. And then you have around it the discovered non-producing pools and also development gas pools. Next slide, please. So in 2022, we are going to drill 5 new gas pools, which are the yellow stars. And predominantly, most of them will be pools that already have been drilled and 100% reserves, but have not been produced. And what we're going to be doing is we're going to be actually reaching out from the existing platforms to directionally drill into those gas pools. Next slide, please. So on our block, we also have very, very good seismic data, and we have very good 3D seismic that was shot in 2007 and later, and then reprocessed at that time to do what they call AVO, which you can identify sands that are actually saturated with gas. We are going to redo it with more modern techniques, and that's for the exploration projects. But for the drilling we're doing now, it is perfect. This is an example of the quality of the data and the structure. So this is just an example of the structure, and you can see the bright marks, and that's actually what's called AVO anomaly, which indicates gas in the sands. Next slide, please. So I just want to show you an example of the discovered pools. So they've been drilled, they've been tested, they've been mapped, and the wells have been temporarily abandoned to be re-entered, but we're not going to re-enter. Like I said, we're actually going to reach out from the platforms. And because this is all mapped and drilled and so on, there's absolutely no mystery we know it's there, and that's why we have that third-party reserve report. And to be a reserve, it has to be there. It can't have any risk associated with it. Next slide, please. This is just, again, an example of the quality of the data. So when you drill a borehole for hydrocarbons, you send instruments down the borehole, and you then can indicate which ones are gas bearing and which ones aren't. So this is the example of the 3 zones that were tested in this well. And these 3 zones tested 7.2 million cubic feet per day. And so this is what's included in the reserve report. Next slide, please. However, there's 4 more zones in that borehole, in that well, that calculate gas that have not been tested. And these cannot be classified as reserves, even though we know they exist. So this shows you that the amount of upside we actually have in these boreholes. Next slide, please. So this is what we intend to do. So you have your platform. We bring in a jackup rig. There's 2 of them in the area. They're actually in Romania, so we have them lined up. The jackup rig snugs up to the platform, and the drilling rig hydraulics over the platform and through a slot in the existing platform. We will then drill out and directionally to the proven prospect. It's much cheaper this way than standalone. So instead of costing $20 million, it'll cost us about a little over $8 million per well. Next slide, please. So this is just an actual seismic section indicating one of the projects that, well, the well that we're going to actually drill. We have engaged Schlumberger, who are an expert in directional drilling, and they own the tools and stuff like that. So it's a small uplift in the price, but it's well worth it when each well is worth about $8 million. So you can see the words on the left: platform, production platform. So we'll end up going from there, directionally drilling, and then curving down, hitting our target, which we know is there because we have an existing well location, and we've tested it. So after we drill, it takes about 30 days to drill. We then recomplete, and the drill borehole with the casing in it now is basically our pipeline. So there's no subsea pipe to put out or anything. And that results the fact that we can then put these wells almost immediately on production, like within 15 days of recompletion. And then we'll get our first paycheck from the well about 30 days later. So it's much faster and more cost efficient, and we get quicker revenue by drilling off the existing platform. Next slide, please. So after we drill those first initial wells, which we call our program A, we then will go into the development locations, and we call them low risk because and that's the yellow stars. A lot of these locations are just small faulted remnants off existing pools that have been either drilled or produced. But because there's a small barrier and is also a certain distance from the well control, it cannot be classified as a reserve. So it has to go into the resource as a development. But some of these locations are upwards of 90% of a possibility of occurring. So it ranges between 90 and 60%. Next slide, please. This is just illustrating some of the cash flow that we will end up using to continue some of our funding. And because the wells are, so quickly drilled and put on production right away, we can ramp up fairly quick our free cash flow from the wells. So the program A, our percentage is at about 22 million US to drill the 5 wells and recomplete 2 wells. And what I mean by recomplete 2 wells is that some of the wells have water that's gone through the upper or lower from the production zones. And one of them actually has the production tubing is bent and therefore constricted, but the existing wire line on the platform doesn't have enough torque to pull it out. So we will correct that when we have the jackup rig. And one of these recompletions is almost like a complete new drill, but it only will be about 1.7 million to do that. The program B, which or the other locations which I showed you, is about 43, 44 million to drill another 8 wells, re-enter one of the wells. And in this case, we'll be doing a subsea tie-in and to one of the platforms. And the reason for that is we have 3 small pools that form one structure, and we'll put in 3 wells in there and then do a subsea tie-in to the Akcakoca platform into our system. Again, this is the old price forecast. So the A drilling program, as you can see, will be up to a max of about 2.7 million US per month. And that's after all costs like op costs, turkey costs, all that kind of stuff. And then by the second B program, we're going to get up to about 5.8 million US for the project there per month. And you can see the way it's sloping, and I have there any stratigraphic exploration drilling will flatten this curve. So the program A and B are just the GLJ reserve and resource report. Next slide, please. This is just now illustrating, again, this is the oil gas price forecast, that Trillion Energy is severely undervalued. Right now, our shares are about 17 cents US, about 21, 22 Canadian. The current company value is 32 million US. But if you look at the NPV 10, just from, like again, the old forecast, our 49% in the far left little block there, it says about 148 million. That's NPV 10. That is the most pessimistic case from the third-party engineering report. And what I mean by that is they used a low recovery factor, say like 50% for the P1, then 60 for P2, and 70 for P3. Whereas because we know these fields, we know everything about them because, like I say, from birth to death, we know the recovery is 80%. Plus, at the same time, for the development locations, they penalized us about 10% by saying, if you don't get the money to drill it, this is what the value is. I look at it, if I don't get the money to drill it, it actually has no value. But so the next 2 bars, it says US 214 million. That is removing that 10% and also putting the actual recovery factor in it. And when you go into the 3P and high case, you're starting to get up to 360. But you can see that a fairly good case, say about 250 million US. And right now our value is 32 million US. When I put the exploration prospects in it, we start getting up to 450 million and 800 million. Next slide, please. Funding for Program A and Program B. Like I mentioned, we are redomiciling the company to Canada. The S4 has been accepted by the SEC in the States. And December 17th, we have our special shareholder vote to redomicile to Canada. And because of where the company originated, we need a shareholder vote for that. This redomiciling is pivotal to securing a brokered financing with the Canadian Investment Bank to fund this. And that's because they don't like the legend that it's got to be held for 6 months. And also it's substantially less expensive to do it this way than to do a brokered financing, like file a prospectus in the States and in Canada. we'll be announcing a brokered financing for the Program A upon conclusion of the shareholders meeting, because once it's redomiciled, we have a deal in it waiting. And then at the same time, we're doing debt financing for Program B. And the success of Program A, as you can understand, when we start showing, we're getting these monthly cash flows. We start having nice little clips of the gas flaring on the platforms and all that kind of stuff. That will make debt lenders, I'm talking 100% debt lenders, more secure and happier because they know we got enough cash flow. And we'll also, we'll have a lot more reserves and be more stable for them. And we're trying to secure a plus 50 million US debt financing. So Program E, like I have, is the key that unlocks SASB treasure chest. Next slide, please. I'll just do this quickly. I mentioned the GLJ reserves and prospects. Also on the property, we have stratigraphic traps that appear to be gas charged. And like I said, with the seismic, and it's called AVO, you can actually get anomalies. And so, and with the stratigraphic will be like a buried river channel or a deltaic environment type thing. And so these anomalies indicate that you have gas saturation, but we want to, how can I say it? 10 years is a long time and technology really advances. And so with the new, for $500,000, I can get the seismic processed to be able to fine tune more clearly, say an 80% gas saturated sand versus a 50% gas saturated sands. And all that does, it just mitigates some of the risk. And I look at it, it's better to spend $500,000 than end up drilling a well for $8 million that has a 50% gas saturation, which you will get gas, but you'll start having water issues early. Next slide, please. Now, besides on our block, so you can see our block in this picture, the red north of that, that's all owned by the Turkish Petroleum Company, and that's the deeper water, and that's their big discovery. But there's that strip of land in between that industry can pick it up, is classified as shallow water. Next slide, please. So there's part of that strip. Again, there is our block, and you can see the 3D seismic covered on it. That red block, our predecessor and so on, and I still have the same technical people, have been there for 20 years. We used to have all that land. We have 20 years of data. We have the experience. We have the seismic. We have structures mapped out. And like I said, though, at that time, the conversation was there was not enough gas to charge these structures. And when I'm talking about these structures, I'm not talking BCF, I'm talking TCF. So they're very large targets. And so we'll be pursuing those. Roughly at the same time, we'll be drilling, like finishing off our drilling of the A program and starting our B program. And so, and like I say, we have all that data. So the conclusion is that we have a paid for infrastructure. So it's underutilized, it's there, it's in very good condition. So we don't have to pay for all the platforms and so on. We got it on pennies for the dollar. We have 100 BCF of low risk gas. I always say, if you went back and you didn't have that infrastructure and you looked at these targets now, you would not pursue it because it costs $600 million for this infrastructure. But the fact that that infrastructure is there, these gas deposits are very lucrative. We're going to announce a brokered financing for Program A once redomiciling into Canada, followed by a potential debt financing to execute Program B. Our shares are extremely undervalued. Like we have 185 million shares out. Like I said, the range we're in right now is about between 200, 250 million US. So at Canadian 22 cents, we're very undervalued. We have drill ready locations that are well defined. because they're being drilled, mapped, everything. Production starts almost immediately, and the wells will produce 4 to 7 million cubic feet per day. And projected net after costs, and I must have been sleeping when I did this one, because actually it's 1.8 million in September, October 2022, and then 2.7 in March 2023, and then would be up to about 5.8 in September, October 2024. And then we have the future larger exploration targets that are, are like 10, 15 times larger than what we already have on the block. Next slide, please. And like I say, we have 185 million shares out. Our market cap here in Canadian is 41 million, and our shares are about 22 cents. Next slide. This just shows you we have a very good management team with lots of experience. So that's my presentation. Thank you very much for your time.
Hi, Art. Thank you so much. So we'll take questions now. I have quite a few here, so let's get started. Who are some of your main shareholders?
So up until now, we've basically had just been family and friends. We've been internally raised the money. So now we are going out to larger brokerage firms and so on. But one of the main shareholders is myself, like management. I probably own about 10 million shares and probably another 2 million derivatives. Other than that, most other shareholders will have a max of about 2 million.
Okay. And so you did mention that once you're re-domiciled here in Canada, you're going to be doing a private placement. But right now, how far does the cash you have on hand take you?
So the cash, so what we did was I accelerated the warrants. So I have enough cash to go until next summer.
Oh, okay. Excellent.
Yeah. And we also generate revenue in Turkey too, right?
Okay. And so speaking of Turkey, what is the permitting process in Turkey?
For like an exploration block?
Yes, exactly.
So what'll happen is, and that's why we have an advantage, we have the data and we also have the infrastructure. So an example would be, we would end up doing some work, pick the best prospects. We would then apply for a block, an exploration block. And on that exploration block, we would outline, usually it's about 4 years or 3 years worth of work. And then that will be gazetted, and then anybody can bid on it.
Okay.
Right. And so they'll pick the best bid. But the fact that because we have the infrastructure and we have the data, we might end up saying, okay, we're going to drill 2 wells instead of 1, because off our block into more deeper water, it's more expensive.
Okay.
And then if ours is a winning bid, then we get the block to do the program. And then we have to put up a 10% bond for the work that we say we're going to do.
Okay. And so then who's taking the product that you are currently producing? Because you did mention that you're producing. Yeah,
so in Turkey, they import 90% of the gas.
Okay.
And so we have an industrial buyer. So they buy the gas and they sell it to industrial users. And in Turkey, it's a seller's market. So if we didn't have this buyer, there'd be somebody else there very quick.
Okay. And are you guaranteed gas prices for like a particular term or monthly, or how does that work?
Yeah. So what happens is the gas, because 90% of the gas basically comes from Russia, it's based on the BOTAS price forecast, and they can look it up. And that's the Russians what they use, and they basically use the Brent oil price forecast. But when the European market gets squeezed, we get an uplift, right? And the only reason why we got a dip in COVID, because everybody knows that the Brent oil price was fairly down, but the price is set every month.
Okay, monthly. And then so on the ground, who's running the project for you?
So I have 12 people there. We have an office in Turkey. That's where our head office actually is.
Okay.
And so my manager has been there since 2006. Predominantly, most of the staff has. So they run the day-to-day operations in Turkey. And then for SASB, when the drilling part, we operate the drilling part because we have the expertise in shallow water drilling. But to operate the field, TPAO, our government partner does. And so there's a huge staff that, that run the boats and all that kind of stuff. And that's looked after by TPAO, which is a better deal for us.
Okay. And so here's a two-part question. So are there any supply issues?
Well, in oil and gas, there always are supply issues, right?
Okay.
So, and COVID has caused a little bit of crunch, but because Turkey has, it's not a large oil and gas industry, but it's a well-established oil and gas industry. And because it's close to Europe and other suppliers. So an example would be for us to drill our program, say I'm going to drill the first program, 5 wells. I need 15 kilometers of casing. I actually have to put the order in to the Chinese foundry. They will give us a ticket. We'll stand in line. When our order is done, it will then be shipped to Turkey, and then we have it. And so some of the items are 4-month lead time. So when you put your order in, you'll get it 4 months. But that again, because we drilled all the other wells, we have that supply line figured out.
Okay.
But with COVID, as you can imagine, some of the foundries are short staffed and so on. So there's a couple of extra months.
Yeah, that's like everything right
Yeah.
now. So, and here's a great question. How is the gas transported to land, and how is oil and gas separated?
Okay, so we have absolutely no oil production in this gas. This is strictly a gas field. The oil production that we have is on shore. It's in the southern part of Turkey, and that's through a pipeline. But so this one here, what happens is the gas is produced up the borehole onto the platform, where it is then put into the gathering system, the pipeline that runs along the ocean floor, up into our facility. In our facility, it's cleaned, like it might have a little bit of nitrogen or CO2. So it's clean, so it's within pipeline spec. It then goes right into our gas buyer's pipeline.
Oh, okay.
And then distributed throughout Turkey. Yeah.
Wow, great. Paulus, you've joined us. Do you have a question or two for Art?
A couple, yeah. Because you're not 100% owner of the wells, you've got like partners. You own like this percentage, and you have 49%, but you also have part. So how does it split out to you? I mean, you're not the operator, right? Because somebody owns 51% of the projects. Yeah,
so it's pay your share. So we pay 49%, they pay 51%, and like I say, we operate when we drill, but they operate the production. So what we have is it's like meetings where the budgets are defined and stuff like that, and so they do cash calls. So it works out a monthly fee depending on the gas production between 80 to 100,000 a month.
Okay, so and whatever is produced, your percentage is split to you on the percentage that you own of that well.
That's correct. Yeah.
Okay. Now, are there any environmental obligations that you have to put money aside for because you're drilling like on water?
Well, so we have all our permits and so on in place, but we have insurance.
Okay.
Yeah, we pay a lot for insurance, and the reason for that is for just what you said, right?
And how much can you produce on a daily basis? I mean, do you have a limit, like where like your equipment only can download, like offload X amount, or?
No, so we have what we've done. Okay, I'll answer that quickly. Without any issue, we can go 35 million cubic feet per day. We could get up to 75 million cubic feet per day by just changing the offtake to the seller.
Okay, so that's all taken care of if you do run into any kind of problems.
Yeah.
A couple other questions here, just one more. All right, so I mean, who runs the projects? I mean, you're 49%. So are you the one that does the drilling, or who does who's responsible for getting stuff done?
Yeah, so TPAO is a huge company, and they've got so much land, and we're kind of like a little mosquito, right, out in the Black Sea, and so they are 51%. We don't do anything without sitting down and talking to them, but we initiate the ideas, and we organize any perforations, any well drilling, all that kind of stuff. But when it comes to the production of it, going out by boat and making sure that the compressor's working, making sure that the facility is all okay and stuff like that, they do that. And the reason for that is you're talking like 20, 30 people for all that. And that would be TPAO staff. And so it's much better for us because we run ours with about a crew of 12.
Okay, I got you.
Yeah.
And one final question. You've talked about that you have 4 non-producing but ready to produce wells.
Yeah.
Now, what's the cost of opening up a well that you know that is going to be productive?
Yeah. So what I said, we're going to actually drill them from existing platforms, right? So we will drill directionally. We'll go out horizontally a certain distance, and then curve down and go into it as close to the old borehole as possible. And that costs 100% right now, 8.7 million.
Okay, all right.
I have another question for you here. You mentioned that the new wells might produce 4 to 7 million cubic feet per day. What type of drop-off rate in production would be expected in 12 to 24 months?
That's got to be an engineer. So that's a very good question. So as we start putting more wells on, we will be choking back the wells because he's correct. You don't want to produce a well at its maximum rate because you're going to start getting improper movement and all that kind of stuff, and you're actually going to be leaving reserves behind. And these wells have a very steep decline for the first couple of years, so they will drop off about 25-30% of the production will start dropping off at that rate, and then it tails out. And that's why the goal is to keep bringing these wells on. But that's why these wells are very lucrative in making money, because we'll get predominantly most of our cash in the first 3 or 4 years, and payout for the $8 million is like less than a year or a year and a bit. And so it's like a big balloon, right? But you can see we're still producing some of the wells from 2007. And with the expertise we have, what we do is we start phasing down the offtake pressure.
Okay.
Okay, I have one final question. What's the lowest price of gas that would still be sustainable for you to keep producing?
So with the offshore and stuff like that, it's slightly over $2.
Oh, so you have you've got a good cushion there.
Yeah, the lowest price we ever got was, and this is since about 2007. The lowest price we got was last year, and it was just under $5.
Okay, all right. So you've got a good cushion, and that's the reason for my question. Arthur, thank you so much for today. Much appreciated. You have your meeting like to re-domicile back in Canada, and you explained all that, so that's good to go. Yep. So by December, by early next year, you should be having a pretty good plan in place, right?
That's correct, yeah. And thank you for the opportunity to get the story out.
All right. Thanks for your time. Appreciate everybody that joined today.